Hey guys, John Paulamy here, Actionable Intelligence. Today is Sunday, February 17th, 2019, and welcome back to the market update, weekly update. I missed last week, I've been busy, but lots of news and lots of things to report on. The first thing I wanted to talk about this week was the Cameco 2018 earnings call that happened last week. And we like to review Cameco's views or its quarterly reports, and especially the management's comments, because being the second largest uranium producer in the world, they have particular insight into what is happening in the uranium market. So, a couple things I wanted to go over that were of note to me that I think pertain or people should be aware of. One of the things I would note would be that Geitzel basically said on this call that they're playing the long game, and there's going to be some short-term pain for long-term gain. I think that's an exact quote. So one of the things that I think that people need to be aware of is the fact that, Cameco shut down McArthur River, Key Lake, and they said last year that they would be entering the uranium market, spot market. And what they did this year, in 2018 at least, last year, is they really, to meet their customers' demand, they really didn't pick up too much material in the open market. They really drew down their inventories. And their inventories at the start of the year were 27 million pounds, and they drew those down to 8 million pounds. Now, they put various RFPs out, which are requests for proposals, but they didn't get anybody to bite on them for the prices they wanted. So they drew their inventory down to meet customer requirements. Now, their inventory is down to about 8 million pounds. They're not going to draw it down to zero, obviously. They're going to want to keep a minimum amount of inventory on hand, 5 to 6 million pounds, I think is what I heard. So that means that now, I have a slide coming up here on the next slide that shows what they need to deliver this year, and not having enough mining capacity online, they're going to have to seriously go into the market now and start forcing the price up to get material. So I think that's number one to realize. Is like everybody's wondering, well, if Cameco is in the market in 2018 buying material, how come the spot price isn't going up? Because they really didn't buy that much material, I don't think. So I think they were feeling around, they were probing the market. I think they were gathering a lot of intelligence, and in the meantime, they drew down their inventories. Now they really don't have a choice. They're going to have to buy material. So that should be interesting in 2019. One of the things that Geitzel said also was, when I say Geitzel, that's the CEO, Tim Geitzel. He sees producers abandoning a volume strategy for a value strategy. Well, they have to. I think what he's mostly talking about here is, a lot of producers overproduced after Fukushima, after the price collapse, because they had term contracts that they were able to deliver into, and that allowed them to cash flow and have earnings. When those have rolled off, you're now in a situation where you can't sign a contract at a high price at more than you can mine the product for and make a decent profit. So I think this is maybe directed more at the Kazakhs and Kazatomprom, certain advantages they have, but even they're pulling back now, or so we think or hope. With their IPO this year, they're a traded corporation. They have shareholders, including the Kazakh government. So it's in their best interest, and the CEO of Kazatomprom has said this in the past. I've seen him on interviews where he said that they need to get away from the old Soviet 5-year planning, just produce for the sake of producing, because that's the plan, and start maximizing the returns on their asset, which are, of course, an extractive industry as you mine out that doesn't replace itself. So these are valuable resources that should not just be given away. Another thing that was mentioned was the lack of adequate long-term contracting opportunities. Cameco's not seeing a lot of the utilities come in And I think that is, especially in the U.S., is a direct result of the 232, Section 232 deal that's going on that UR Energy and Energy Fuels instigated. I think and I will point this out later on in the slides, Mike Alkin had an excellent interview this week with the CEO of UR Energy, and they went super in depth into what is really going on and why the quota was asked for, or the 232 petition was filed. And I really thought it was excellent. Especially, you really have to listen to it if you're invested in uranium stocks, because the CEO of UR Energy basically goes into the depth and basically makes a statement. I don't want to say allegation, but a statement that U.S. utilities don't even want to deal with U.S. mining companies. They would rather just go to the Russians and have a soup to nuts, fuel processing, uranium supply. They don't want to go to a small company like UR Energy and dick around with 500,000 pounds or whatever. So that was a serious statement, I thought. And, just from a policy, purview, I mean, this guy's really plugged into what's going on. And that I listened to that lecture or that interview twice. I probably listened to it again. It's very, very instructive and educating. You have to listen to it. And I have a link to it, and I'll put a link in the show notes. The other thing Geitzel said was, and I think this is important, and you guys need to listen up because I've been saying this. He said, uranium, quote, is a business where progress is not measured in weeks or quarters, but years. So I think, going back to what I've said before, I believe that, we are in a situation where we have this critical commodity that's required to fuel, these nuclear power plants that cost $3 to $6 billion to build with all that sunk cost. They're not going to go away, and there's no substitute. So with the price being down so low, there has been no significant investment. We have an investment gap that has developed, okay? But the problem is because of some short-term things that we need to get through, i.e. the 232 resolution that's holding U.S. utilities back from entering into contracts, and, maybe some further supply destruction that needs to take place to further drive down the supply. But I think long term, if you look at years, 3 to 5 years, the uranium price is going to be substantially higher than it is now, from a simple fact that there has been no investment. We are living off the roadkill of previous uranium industry investments that were made years ago. No one is building new uranium mines. No one is investing in new uranium mines. But yet every day, reactor fuel is being burnt up. So that is the when, not if scenario. So, but it's going to take more than a week or two. So we've been saying that. I've been in physical uranium. I've done well. It's up, over 40%, going on 50%. Cameco's done well. I've suggested that these could be, these were good base holdings to have, as this thing was going to take longer than we thought. There was a mention in there about we talked about 232, and that is holding back contracting, especially by U.S. utilities. My view on this thing is basically, my reading on it is this is going to take a lot longer than everybody's expecting. Will resolve to higher prices for uranium and the uranium mining companies that still exist when this happens. So again, I go back to what I've said before for the last year and a half, 2 years that I've been talking about this. You really have to know what you own. You need to be associating yourself with competent uranium teams that are also thrifty and know what they're doing. I'm not going to mention specific companies, but there's a lot of companies out there that like to issue shares to keep the lights on. And I'm not interested in being involved with those types of managements. I want people that have a demonstrable record in this industry, that are thrifty, and that are looking long-term and are looking for a payoff. I'm not looking to get diluted, so when this thing finally turns around, the share count is so large that you get no benefit. So I've said that before, and I'll say it again. You have to be really choosy in this market. One of the things I also noticed is recently, just over this weekend, which I thought was interesting, and I'll mention in passing, looks like a lot of these crypto guys are starting to move into the uranium market. John Quakes was interviewed on a blog that I read. I can't remember the name of it, but they were talking about this, and there's a lot of appears to be a lot of interest from the crypto community. It's starting to make its rounds over there. Some of the influencers in that industry have been talking up uranium. So I find that to be interesting, and that could be a catalyst once this thing gets going for some additional fuel to the upside. You got to remember, very small market cap. The entire market cap of this industry is only right now about 7 or 8 billion. I don't even know, might be lower than that. Most of that's Cameco. So when this thing gets going, if the money starts coming in from the crypto guys, look out. Okay, let's check out this other slide from the Cameco deck. And I think this is instructive. Let's go over this. I mean, they're going to have production this year of 9 million pounds. They need to deliver 28 to 30 million pounds. So because they've shut down some of their mines and they've drawn down inventory last year, they have no choice but to purchase 18 to 21 million pounds in the spot market. So I think this is the year where you're going to see the spot market start moving up. This thing, once it gets a 3 handle on it, I think is going to draw a lot of interest. I mean, everybody's going to sleep over here at $28, $29. But, like I just explained, Cameco really wasn't hard in the market buying last year. They had RFPs out. They didn't get filled at the low prices. They've drawn down their inventory. Now they have no choice. They have to go in there and start pushing up the bid to start forcing some of that material to shake loose. So this is a really excellent slide. Like I said, with 8 million pounds of inventory, they're not going to draw that down to zero. So they're going to be out there. I suspect you're going to see the uranium price start moving, spot price. Here's the slide. I'll put this link in the show notes. Again, the Mike Alkin interview this week with the CEO of UR Energy. Excellent, various scenarios around the Section 232 and what the possible outcomes and ramifications of that could be. There was an interesting discussion on the fact that utilities would rather deal with Russians on a soup-to-nuts contracts than mess around with small U.S. producers. That's kind of a synopsis, but you have to listen to it. And that's very discouraging. You basically have U.S. utilities selling out the U.S. small producers just because they want an easier deal with the Russians. And it's not even based on price. I think it's just more convenience. And, this is really a national security issue. Nuclear power, of course, is 20% of our electrical grid, and we import 99% of our nuclear fuel, the majority of that coming from countries that are Russia or I wouldn't say controlled, but allied or basically controlled. I mean, Kazakhstan is basically controlled by Russia. So if you go there, everybody speaks Russian and it has Cyrillic writing. So you can figure that out for yourself. And that's just a dumb policy. And regardless of what you think, people like Wilbur Ross, who's the Commerce Department Secretary, and Donald Trump, who's a nationalist, are not going to allow this to stand. I think if you present this rationale to the president and to people like Rick Perry and Wilbur Ross, there's going to be a positive outcome, in my view, that's going to benefit U.S. producers. I don't know how it's going to come out, what the quota is going to look like. I don't know what they're going to do. But I would suggest to you that there could be a 2-tier market. And like I said, listen to that interview. You got 2 smart guys on there, and they go through all the different scenarios. So I would definitely check that out. One of the commodities I'm getting into big time now is copper. And the reason why is basically twofold. On the demand side, you have the emerging markets, China, India, all these other smaller countries, Bangladesh, Vietnam, Indonesia, places that, all of Africa. And in these places, you see a continued urbanization and, emerging markets, if you will. and building out of the power grid. And I thought an instructive story was to illustrate this was the recent Goring and Rosenzweig blog or report that talked about this. And the discussion was around India. Now, in India, the Prime Minister Modi said that one of the goals that they had for the country was to fully electrify the country by, I think, end of last year. And they made the claim that they, in fact, had done that. But it was kind of with an asterisk. And what the asterisk was that they had ran electrical high tension, high voltage lines by every town and village, but not, and those lines, by the way, are aluminum and steel reinforced. They are not copper. Those very high voltage, high tension lines you see are not copper lines. So that kind of came out. It's like, well, they considered it electrified, but it really wasn't. The people in the villages and towns still didn't have electricity. So that was kind of an embarrassment. So there's been a big push now to fully electrify these places. And what I mean by that is, if you walk outside and look up at your power pole and you see that round thing sitting in that cylinder, that's a transformer. That's stepping down the voltage off the pole from about 12,000 volts to 240 that you can use in your house. And inside that cylinder is a lot of copper winding. And the same thing in substations with bigger copper windings inside. So suffice to say that there's a tremendous demand in these places for copper due to electrification. Now, in India is a particularly interesting case because I would suggest to you, and based on some of the things that my research has shown, is that India is basically entering the S-curve, if you will, of its commodity demand. It's basically where China was 20 or 25 years ago with respect to commodity demand. Let's talk about copper, for example. I'm just going to give you some rough numbers. These aren't exact, but they're rough. I'm trying to recall from the reading. The installed per capita copper in China, for example, is like 176 pounds per person installed for the electrical grid. The comparable number in India is 14 pounds. It is over 10 times less than it is in China. And the government was embarrassed by the fact that it was pointed out by the press that you didn't in fact electrify the country. You just basically ran high tension wires by every town and village. So the gist or the focus going forward to remedy this is now to, pull that high voltage down into substations, knock that voltage down with a big transformer, and get it into these cities and towns and these villages so that people can have electricity. And that is going to lead to a tremendous amount of copper demand. Now, that's not going to single-handedly push the market. What I'm telling you is that you start, you're talking about 1.3 billion people. You're talking about the same thing happening in Bangladesh, the same thing happening in Pakistan. You're talking about the same thing happening in Vietnam, Myanmar. These are tens of millions of people that are getting hooked up to the grid. You have the Belt and Road Initiative of China is going through a lot of these same places. So what I'm telling you is there's a tremendous demand coming from emerging markets for electrification and urbanization of the populations. Now, let's throw in renewable energy. As we build more and more wind turbines, each one of these wind turbines that you drive by has its own generator internally. Those are all, generators are full of copper windings, okay? I don't know how many hundreds of pounds or thousands of pounds, but it's a tremendous amount. And the turbines are getting bigger and bigger. I'm just on a job now where we're doing a repower, and we're taking a site, where the turbines were kind of small, up to 2.5 megawatts per turbine. So these things are getting bigger and more ubiquitous. Whether I like it or not, I don't comment on the zeitgeist, the politics. I'm not a policymaker. I'm here to make money. So this is what's happening. On the other side of the coin, when you talk about supply, it's very interesting. And I'll get into some charts here. The supply, same thing, not enough investment has went in. And what we're finding is all of the low-hanging fruit, if you will, the easy-to-find deposits have been found. They have been exploited. They are getting tired. They are getting worn out. They are running out of material. And going on to where I think the opportunity is this chart's very instructive. And we've seen this same kind of chart with other commodities like oil. Here we have a chart that shows the copper discoveries are way, way down over the last, 10 or 15 years, So every year, the demand is there for 20 or whatever it is, 20 million tons of copper a year or whatever, and growing, by the way. It's not going down. The quality of the mines that are being found are lower, and the number of them are lower. So at some point, this is an issue. This becomes a problem because if you're extracting, this is what we love about these extractive industries. If you're not replacing the material that you're mining out, at some point you go out of business. And that just has not been happening. Now, I don't know if that's a phenomenon of geology, lack of investment. These all, I think, are part of the picture. But if the price goes to $4 or $5 a pound, I can tell you that sufficient copper demand will come online. And every crackhead will be out stealing cables off, wherever they can get them. So, again, price is the incentive maker. It incentivizes people. As Charlie Munger says, show me the incentive, I'll tell you the outcome. If copper goes to $5 or $6 a pound, more mines will come on. But it will take some period of time, and that's the opportunity. So supply down, and here is demand overtaking supply. So as of the last couple of years, we've been in deficit, and it's projected that the deficits are going to grow over time. Why? Because of the insufficient investment, creating new supply, and increasing demand. Very interesting that I want to point out that the last month's or February issue, if you will, should be this month's, of the Actionable Intelligence Alert, I actually recommended a copper stock that has no mining risk and has decades of copper supply and has brought on additional supply at a very low cost and has lowered its cost per pound. It's basically a company that doesn't do any mining. It basically processes another miner's tailings, historical tailings and current tailings. And what I mean by tailings is like after the original copper miner processes the ore that it has mined, this company takes that waste and processes it further and extracts even more copper out of it. And it also does it from historic tailings dumps that go back to like 1910. So, and like I said, this company just basically doubled its production, did a big investment. So that's the kind of companies I like. I don't, we're looking for cash flow. We're looking for, companies that don't have a lot of risk, but we could take advantage of these scenarios. So if you're interested in that, take a subscription to Actionable Intelligence, or you could become a Patreon member. And all new Patreon members who donate $5 or more, I will send them the current issue or stock pick. I shouldn't say issue, the current stock pick for the Actionable Intelligence Alert. And you could understand what this copper company that I'm talking about. I think copper is becoming like my second or third favorite commodity or resource that's going to rebound. Obviously, oil, uranium, and now copper, I think, is in the same boat where we're going to see a tremendous amount of demand, but diminishing supply, which will lead to higher prices. So I'll be talking about copper more in the future, but I'm going to throw an article up on my blog that I kind of explained my copper thesis in the newsletter that will be available for free also on the Actionable Intelligence blog. One more news item I wanted to throw out. I thought this was interesting. Central bank gold demand. Take a look at this chart going back to 1970. The majority of the actions by central banks has been to sell off their gold reserves. There's a few years here and there where they were net buyers. But then notice what happened basically from about 2011 to 12 going forward. Okay? Central bank gold demand has been tremendous over the last 7 or 8 years. And you have to ask yourself why this is. Now, I have various theories. I think a lot of the central banks around the world, especially like in China and Russia and some of these other places that are big gold buyers, and Russia is one of the biggest, I think we're getting to a juncture in world history. We are going to see the transition of power and reserve currency status move away from the current holder, i.e. the United States. Now, this is not something that's going to happen in a year or two, probably. It takes time. But I can tell you right now, spending a lot of time in Russia and these other places, people are sick and tired of the U.S. telling them what to do all the time and threatening them to bomb them if they don't do it. And the only way that the United States is able to get away with this is because it has the reserve currency. It's able to print these currency units and buy stuff with it and use it as a weapon, if you will, by forcing everybody to use the SWIFT system and forcing everybody to trade major commodities in dollars and just settle in dollars. I'm not a conspiracy theorist, but it seems like every time somebody talks about using a foreign currency, like what happened with Saddam Hussein and Gaddafi, when they were talking about selling oil for some other currency besides the US dollar, all of a sudden they're gone. They're out of power. Same thing's happening in Venezuela. I mean, that's not the only thing that's happening, but Maduro's been talking a lot of smack down there. It's the same way. He's getting ready to get the smack down. So it's very interesting when you listen to central bankers poo-poo gold, especially in the West, but yet we have them buying, for this to be a barbarous relic, I guess what I'm saying, of no use, or if Warren Buffett says, it's just, rocks in the ground. It's interesting that we see a lot of central banks have been net buyers and tremendous net buyers. And I think that the over-indebtedness of the world, especially in the Western OECD countries, emerging markets now starting to flex their muscles, not wanting to be under the dollar hegemon, I think this has a lot to do with it. And I think that gold has been a store of value for 5,000 years. It will continue to be because of the properties that exist in it that make it money, which I don't have time to go into in this video. But suffice to say, I thought this was interesting. I saw this on a website, and I wanted to grab it because something's going on here. And I will just quote Ray Dalio, the guy that runs Bridgewater. He's a multi-billionaire. And, he said this to the Council of Foreign Relations. Somebody asked him if he owned gold, and he said, yes, he did. And then everybody started snickering, and he said, well, if you don't own gold, you don't understand history or economics. I had some smart ass on Twitter tell me that I don't understand opportunity costs, but he looked like he was about 22 years old. Like, guy's never been through a market cycle, so we'll see. But when I see smart people buying gold in volume for years, something's up. Like I said before, I'm an advocate for gold for insurance purposes. People should own it. They should consider it as a asset class, as something that they hope doesn't go up in value. Because I can be frank with you, I've talked to a lot of gold bugs, and they're like, well, I can't wait till gold goes to $5,000 or $10,000. You don't want to live in a world where the price of gold is $10,000, I can assure you. So that's it for this week, guys. We'll try to keep up on these videos as I can, but I got a lot of other stuff going on. Again, any comments, suggestions, brickbats, whatever, I can take it. I don't really care. Whatever you want to say, I don't shut comments off. If people want to be ankle biters or if they have something serious to say, I answer everybody and I try to engage with everybody. So that's it for this week, and we'll talk to you next week. Thanks, guys.